Is it time to take profits in energy stocks? That's coming up on today's 3 Minutes on Markets and Money. For a whole lot of reasons, of course, energy prices are on the rise this year, whether it's Russia, Ukraine, an undersupply of oil in the U.S. because of regulatory changes, whatever the causes are, energy prices are up and rising, and energy stocks have really been kicking the tires this year, particularly with that index up almost 50% this year, while the S&P is down 14%. That is really just an amazing outperformance and something that historically doesn't last very long. So the question now becomes, is it time to start taking profits in those energy stocks? Well, it might be. If we take a look at energy prices as a proxy for energy stocks, because they do trade very closely together, currently right now, oil prices have risen to around $118 a barrel. Now that is 3 standard deviations, almost 4 standard deviations above the 50-month moving average. So again, a 4-year moving average. We're now 3 standard deviations above that level. That's an incredibly far stretch of prices above long-term moving averages. Now remember, moving averages are averages for a reason. It means that prices had to trade above and below that average over a period of time. And don't forget, it wasn't just so long ago, back in 2020, that energy prices traded negative. We had negative energy prices in May of 2020, stocks trading 3 standard deviations below that same 50-month moving average. So again, both sides of that coin replay each other. Back here in 2020, nobody wanted to own energy stocks because they were in the tank, had no ability to earn money. Everybody hated them for climate change reasons. Now, everybody can't get enough of those energy stocks. Now, when was the last time that we saw energy stocks trade this far above the 50-month moving average? Well, for that, we've got to go all the way back to 2008, where we saw stocks trading well above their long-term moving averages. Ultimately, that set up the decline during the recession, and energy prices fell sharply as demand fell because of the recession in the economy. Here we are once again, very extended, and again, facing a potential recession. So as we start thinking about what are the implications for a reduction in demand over the course of the next year as consumers come under more and more pressure economically from an inability to continue to spend at the pace that they're spending now. That's going to lead to less demand. When you have less demand, supply of oil will rise. Regardless of whether you're actually producing more or not is irrelevant, but there will be at some point a resolution to what is happening between Russia and Ukraine. We will see OPEC produce more oil at some point, or in the U.S., we'll start producing more. Rig counts are on the rise, but whatever the cause will be, and this will occur, you will have a rise in supply and a drop in demand, and oil prices will revert. And again, not necessarily this month, not necessarily next month or the month after, but you might want to start thinking about taking some profits in energy companies. They're very extended on many bases, trading very much the same way as energy prices. And unlike other securities or markets in the world, commodities are very volatile. They tend to trade in a range and then break sharply lower. That's just kind of the history of commodities and how they play out. So the problem is for investors is that one day you wake up and markets are down 20% before you know it. So take some profits along the way. Doesn't mean sell everything, but again, as you rebalance your portfolio, take in some profits here, reallocate that money somewhere else into some beaten up areas that may have a better opportunity as we start getting further into a slower economic environment. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.